Friday, the 13th of October, SJP shares fell by over 20% on a single day. In the past 6 months, it's lost 46% of its market cap. That's around £3 billion with a B. Just evaporated like that. Looking at SJP stock price, market analyst Ernest Hemingway quipped, "How did you lose half your market cap?" 2 ways. Gradually, then suddenly. The following Tuesday, SJP announced what people are calling a radical overhaul of its fees. Oh, now I finally get it. I am getting this. Are you getting it? Listen to this. Consumer duty is a custom-made regulation for SJP. Enforcing it on the rest of us is merely a decoy. The entire retail investment industry is merely a pawn in this cat and mouse game between the FCA and SJP. Let's unpack what's going on with what has been, until now, the UK's most formidable wealth management business. Roll the tape, Jake. Let's go, 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 go. To understand its current predicament, you have to understand its roots. Founded in 1991 as J. Rothschild Assurance by a South African lawyer turned financier, Sir Mark Weinberg, and his protege, Mike Wilson, with the backing of none other than Jacob Rothschild. The business adopted its current name after a reverse takeover of St. James's Place Capital in 1997, when it became a public company. Weinberg was a serial entrepreneur and the father of the variable premium whole of life policy, who founded Abbey Life and then Ambro Life, which later rebranded as Allied Dunbar, also affectionately known in the industry as Allied Crowbar. Having left school with no A levels, Wilson found his calling in the life insurance sales business, becoming the youngest broker consultant at Equity and Law at the time. But what he lacked in academics, he made up for in charisma. Once he gave a speech to 2,000 salespeople, and they ended up giving him, are you waiting, listening to this? A full 10-minute standing ovation. So when the pair started SJP, they not only brought many of their first cohort of life insurance salesmen, and they were men at the time mostly, from Allied Crowbar, they also brought the culture, particularly the art of fee obfuscation that is now synonymous with SJP. Fast forward 2.5 decades later, SJP has become the most dominant force in UK wealth management. And regardless of how much those of us on the independence advice side disagree, it has become the bellwether of how most people, especially regulators, politicians, and indeed the media, think of financial advisors. Don't get me wrong, there are some things to admire, even envy, about SJP. For one, its marketing prowess is the envy of the entire industry. Overall, clients seem to like what they get from SJP. I don't know why, but they do. It retains 96.5% of client asset, better than its own target of 95%. It brings in new advisors into the industry, spending around £12 million a year on its academic program. Last year, I believe they brought in something like 150 new financial advisors, also known as SJP partners, into the business. And thirdly, it gives advisors a framework to quote run their own business end quote with within the giant corporate apparatus that largely shields them from regulatory burden. Of course, the downside of this is that the advisor is restricted to SJP products. And in effect, you can argue that they are conflicted. And in spite of all the competition, regulation, and media scrutiny, SJP has gone from strength to strength. It's doubled its AUM in the past 5 years alone. Nothing has managed to stick. Not RDR, not media scrutiny, not competition. The house of SJP has weathered every storm, sling, and arrow, and it has managed to stand stronger and taller than its peers until now. So far this year, SJP has lost half its market cap. That's around £3 billion. And much of that was on Friday, the 13th of October, following the news that the FCA doesn't seem or didn't seem to believe that the changes that SJP has made to comply with consumer duty is enough. And it seemed that that the FCA actually pushed for quote more radical changes end quote. Now, before we unpack these changes to its fee structures, let's unpack how SJP currently makes money. So it has over 4,693 advisors, they're called partners, and it manages around £158 billion of assets for some 927,000 clients. In 2022 alone, it pulled £17 billion in gross inflows. The net inflow worked out to be about £10 billion. By comparison, the entire UK advisor platform sector pulled 67 billion in gross asset that same year, and that worked out in the end to about 25 billion in net assets. So the point I'm making is every month, SJP clients are bringing in £1.5 billion of gross assets. And even when you account for withdrawals and exits, natural pension withdrawals, people leaving, which doesn't happen that much with SJP, they still net, £10 billion a year. So this is a business with incredible moat. It reported over £1 billion in net annual fees in 2022. Now, of this, 412 million is in what it calls assets in the gestation period. Yes, that's a term you learned in your biology or science class. Little did you know it will become useful in understanding financial services. And fear not, if you didn't pay attention in biology class, we actually unpack what this means for SJP, this idea of gestation period. But suffice to say for now that the implication is that of this £1 billion of annual fees, SJP banked 607 million in net income, and ultimately 410 million pounds in cash profit. Are we getting this? So now this excludes over £1 billion of fees paid out to SJP advisors, to its SJP partners. They are effectively self-employed, and whilst they are paid, from deductions, from fees from the client's funds, it's not included in the income statement that I'm referring to. Of that income statement is like SJP's corporate machine. So there is £1 billion of fees being paid to the advisors, and then on top of that, you have £1 billion in net annual management fees, of which 400 million is on assets still in gestation. So SJP doesn't receive that cash, but it's there. And then you have 607 million actually banked in net income. Okay, so if you go to the show notes on the website, there is actually a copy, a screenshot of its cash results as it's referred to. Now, the problem with SJP has always been the obfuscation of fees. It's a feature, not a bug. And if, like me, you found yourself scratching your head trying to understand SJP fees, rest assured, you are not stupid. It is indeed very complicated. So much so that Baroness Morrissey, former CEO of Newton Asset Management, former chair of AJ Bell, former senior exec at LGIM, Legal and General Investment Management, and a former board member at SJP could not understand SJP fees. Speaking to the Telegraph in January of 2020 about SJP fees, she said, quote, "I have not met anyone yet who can completely articulate how it works in a sentence. I do not believe they are transparent, because otherwise I would be able to explain them to you very quickly." End quote. She couldn't understand. She couldn't explain it. Now, if Baroness Morrissey could not understand SJP fees, what hope does Mrs. Miggins have? But let's try to break it down, the current fee structure. So this is before this new change that they are proposing. In this example, I am going to use an investment in SJP pension and invested in the balance managed funds, so that we can break down the fees. Now, think of the fees as having at least 4 layers, 4 stages. Okay, so stage one is the initial fee that's charged on day one. Stage two is what happens in the first 6 years. So, annual fees every single year for the first 6 years. Stage three is year 7 to 10. And stage four is what happens after 10 years. Now, each stage has three components of its fees. All right. So in stage one, initial fees, you have advice fee of 4.5% of your investment. So if you invested 100,000, £4,500 is paid out for the advice that you received to the financial advisor, or in this case, the SJP partner. Now, you will also pay 1.5% in product charge, initial product charge. So that's £1,500 of your 100,000. All right. So in total, the initial fee would be £6,000 on your £100,000 investment into your pension. Or if you transfer the pension from elsewhere to SJP, for instance, that's what happens. Okay, right. Then you go to the next phase, which is the annual fees that is collected from your pension in the first 6 years. All right. And again, you have three types of fees. The first one is you pay 0.5% a year, every year, for the financial advice, for the advice that you receive. Then there is the product fee. Now, that product fee, normally, we'll get to it, is 1% a year, but SJP waives that fee for the first 6 years. And then the third dimension to that fee is 0.4% for this particular fund in the ongoing charge. 0.42% a year paid for managing the underlying investments. Okay, so overall, in the first 6 year, you will pay 0.92% every single year for the first 6 years. All right. The third stage is what happens in year 7 to 10. Then you're paying the advice fee, 0.5%. Then you're paying your product charge, which is 1% a year. And then you're paying the underlying investment fees for managing the underlying investment is 0.42%. So you will be paying in total 1.92%. All right. Okay. And then the final stage, year 10 and beyond, you will be paying beyond year 10, so you'll be paying 0.5%, half a percent in advice fees. Then the product charge reduces to 0.85%, and then the underlying fees for managing the investment comes down to 0.42%. So in total, you pay 1.77% a year after the 10th year. Make sense? Now, I haven't included, the transaction costs. So there is additional cost for buying and selling, shares within the actual fund that you're investing in. That's not included. SJP sees this, as kind of inevitable. You pay that as part of, a natural process of buying and selling shares, and as they are mostly, almost entirely actively managed funds, that transaction fee can actually knock off maybe another 0.5% of your returns, let's say. All right. So we understand the structure. Now, in addition to the above, there is also the exit charge. If if you move your investment away from SJP in that first 6 year period. So what happens is this exit fee starts at 6% in the first year, and then it slides down by 1% each year. Now, here's the important point to make. Lean in, pay attention, listen in. SJP doesn't really make money from exit fees because very few people leave. It's not designed in itself to generate income for the corporate machine. What it's designed to do is to stop you leaving SJP in the first 6 years. And that's why they waive the annual management fees for that first 6 years. Because imagine if they deducted, 6% of your investment on day one, and then they not only take, the 0.92% a year for the advice and the managing the underlying investment. If they deducted 1% a year for the products charge for the first 6 years, there isn't going to be, there isn't going to be much growth in your investment. You will be underwater most of the time. And so, but to stop you leaving, they apply this exit penalty or early withdrawal charge if you left. And you don't want to leave because then you will be penalized severely for leaving. So the purpose of the SJP's exit penalty isn't to make money per se, it's to stop you living in the first 6 years. The other point to understand is that the initial and the ongoing advice fees, and indeed the initial product fee charge, at the outset, doesn't really make money. It doesn't add to SJP's bottom line. The advice fee is paid to the SJP partner, to your SJP advisor, and the initial product fee has to be amortized. This 1.5% initial product fee charged at the outset has to be amortized over a period of time. So it doesn't really add anything to SJP bottom line. The real cash cow in the business is the annual product charge. Okay, now this is when we get into understanding the magic of gestation period, the magic of the gestation period. Now, about a third of the assets that SJP manages are in what it refers to as the gestation period, which means that these assets have been they've been invested with SJP for less than 6 years. And since SJP effectively waives its annual product fee of 1% in that first 6 years, it doesn't earn any money from this asset in gestation period. Here is how they describe their role model in their annual report of 2022. Quote, the primary source of group's profit is the income we receive from annual product management charges on FUM, fund under management. However, most of our investment and pension products are structured so that the annual product management charges are not taken for the first 6 years after the business is written. So the ongoing benefit of these gross inflows into fund under management for a given year will not be seen until 6 years later. This means that the group always has 6 years worth of fund under management in the gestation period. Fund under management is subject to annual product charge. Sorry, fund under management subject to annual product charge is known as mature fund under management. End quote. So, in English language, what they're saying is of the 158 billion that SJP manages, around 50 billion, a third of that asset, will only start producing income at some point in the next 6 years. They are not currently earning any revenue from it. And so it's expected that once all of these assets come out of the gestation period and they become mature assets, though they will be generating around 400 million pounds a year. Now, here's the important thing. Assets in gestation are in effect guaranteed future profits. The business has already been won. SJP is already managing the money, and there is no additional cost associated with earning a fee from this asset at the end after they come out of this gestation period. All right. And that's why SJP applies the exit penalty, because he doesn't want this asset to leave. It's to stop the asset from leaving. The word is the FCA is still particularly unhappy with the exit fees because it doesn't align with consumer duty requirements to prevent foreseeable harm. The trouble is, removing this will put what SJP refers to as assets in gestation at risk. Because if this asset work, so does SJP future profit, increase in future profit. So, listen to this. Let's talk about the new change, the new changes that's been proposed. The first thing that you need to understand about this change is that SJP is not removing the exit fees or early withdrawal charge for existing clients. So that 50 billion of assets, it's not removing it. The exit penalty, it's still there. Now, I don't know why the FCA allows this, accept this. Well, I know why. There must have been some bargaining between the FCA and SJP on this point. But that cash cow is still not going anywhere. That's not going to be removed. Now, we'll talk about the impact of this later on. So let's bear that in mind. What's actually happening is that they're removing these exit fees and the concept of gestation period for new business. Okay? Now, again, they're a bit vague about when this change will come to effect. Only that the changes will all be in place by mid 2025. Now, if you were a prospect client or a prospective client of SJP, do you wait until 2022 to avoid this exit penalty being applied to your pension, or do you go in now, pay 6% of your investment, and then pay slightly lower fees for the next 6 years? You decide. The second thing they're changing is that they're reducing the initial fees from 6% to 4.5%. What they're effectively doing here is removing that 1.5% initial product charge. And what did we say about the 1.5% initial product charge? It doesn't add anything, doesn't add much to, it doesn't add anything to SJP's bottom line. It's just rounding error because they have to amortize it over a 5-year period, and by the time you're 5 or 6 year period, and by the time you've done that, it works out to be, I don't know, I can't do the maths off the top of my head, 0.25% of new business. That's nothing. So it doesn't make any meaningful difference to SJP. What they try to do is that they are still going to keep the initial advice fee that at the 4.5%. So again, for the SJP advisor, that change is neutral. It wouldn't impact the advisors. Okay, all right, we get that right. Okay, now the third change that they're doing is they are rebalancing these fees to actually show the cost of each element. So they are effectively breaking down the fees to more accurately show the cost of funds, the product or the platform, and advice more accurately and transparently. Does that sound familiar? Sounds familiar to anyone? No? 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 Well, that's RDR. This is what the rest of the industry did 10 blooming years ago. Welcome to RDR, SJP. Welcome. Better late than never, I guess. The FCA allowed this to go on for a decade. And this is SJP is still charging, is still obscuring fees in this way 10 years after RDR. And so forgive me if when people think that, advice fees aren't transparent or they can't understand what they're paying for each element of the advice, well, don't blame me. Blame the FCA for allowing SJP to continue that for that long. Now, there's an important point here. What they're doing is that the advice elements are actually increasing to 0.8% from the 0.5% that they currently show. The annual product fee, aka SJP cash cow until now, is reducing to 0.35% from 1%. And the fund fees appears to be about the same, certainly, from what I've seen so far. All right. Now, this is important because for the very first time, SJP is having to reflect the true value of advice accurately in line with the rest of the industry, what the rest of the industry has been doing for 10 years. This, to some extent, creates a level playing field between SJP and IFAs, independent financial advisors. And what they did previously was to, in my view, undermine the value of advice, and they make product charge or platform fees artificially expensive. Crucially, I expect that SJP advisors will continue to get about the same 0.5% of the 0.8 that SJP will now be charging. And again, this is to show them, this will now show the advisors how much they are actually paying for SJP corporate apparatus. In effect, SJP is charging the advisors about 30 basis point, 0.3% of the 0.8 percent advice fee that they charge the client to provide them regulatory and brand support. So they're providing that regulatory cover. While at the same time severely restricting what they can recommend to their client. That's exactly what's happening. SGP is saying the cost of your regulatory protection and the brand, the brand affinity is 30 basis points. And the way the math works is that SJP needs to retain about 0.6% on its mature assets of 100 billion in order to maintain the net income of roughly 600 million. So this is after paying out, the true cost of the platform and segregated mandates, to third-party fund manager. He needs to keep around, 60 basis points. Okay, so under the new proposal, though, uh, it looks like its net income on mature assets is actually going to reduce to about 45 basis point, maybe 50 basis point. So the corporate apparatus is taking a hit of around 10, maybe 15 basis point as a result of doing this. So I imagine that they're going to get 30 basis points from the advisors, from the advice element, and then they're going to get maybe about 15 basis point from the product charge to make up for, 15, maybe 20 from the product charge to somehow try to preserve their 50 basis point that they're now going to have. Now, crucially, it's important to understand that I don't actually expect that SJP's cash revenue to reduce. They're not expecting it to reduce in the following year. You know why? You know why? You know why? Well, you know why? Yes, yes. That magic of gestation asset, because to preserve the cash revenue, it probably needs about, I don't know, 15% growth in the mature assets. So, and we know that it has 50 billion that is sitting in gestation period, that some of that's going to mature next year and it will start charging fees on them. And then, of course, we know that there will be an new asset that they bring in, is going to start paying the fees immediately. So actually the net income and indeed cash profit is probably going to stay the same as a result of this. So the impact on the corporate SJP, at least from a revenue point of view, the immediate impact is pretty minimal. Now, let's just talk about the point about passive investing. So, in a recent note by Nomis analyst David McCain, he suggested a potential solution to SJP's predicament. Wait for it. You paying attention? Yes. Go passive. I mean, who would have thought that the lowly index fund could even be considered as the savior of UK's largest wealth firm? Cool the stone, the builders rejected become the cornerstone? The proposal was that with a new CEO and CIO and consumer duty, it's the perfect opportunity for a radical change. But SJP has stopped short of adopting this proposal. Although it hinted that it will be assessing its funds, and making some changes to reflect their cost more and their value more clearly. But the jury is still out on whether or not SJP is going to adopt passive investing. A big deal is being made about the fact that SJP new CIO Justin Onokwesi ran LG multi-index range previously, a low-cost multi-asset fund range, and he is the perfect man if you're looking for somebody, to undertake this Herculean task of shifting 100 billion plus to index funds. Justin will be the one. I mean, Justin isn't what I would describe as a die-hard index investor. He and I disagree, for instance, with the value of tactical asset allocation. But I am pretty sure he recognizes the futility of high cost actively managed fund. And I don't know, I have no flipping idea if Justin was recruited deliberately and headhunted for this purpose, or he just happened to be the right man at the right place at the right time. The jury's out on that, my friend. All right. So finally, let's just talk about the impact of this change. SJP has an unassailable moat. Most of the numerous attempts to create SJP Mark II have thus far failed, perhaps with the notable exception of True Potential and Quilter. All of today's private equity consolidators are attempting, in one way or another, to emulate SJP. The exit fee. The exit fee is SJP's most formidable moat. Not because it generated revenue or because it's designed to generate revenue, but because it deters SJP clients and advisors alike from leaving. If you're an SJP advisor and you want to leave, and a third of your client asset is trapped in this thing, that they're going to pay 6%, up to 6% exit penalty to leave, you're not going to leave for 6 years. And in 6 years, you're going to write new businesses. Now, you're always going to have assets in the gestation period. Now, that changes slightly, but not for the next 6 years before all your client asset comes out of the gestation. So to reiterate, SJP is not removing this exit fee or the early withdrawal charge for existing clients. And as we said, a third of his assets is in this gestation period. So of course, when as this asset comes out of gestation, they would the revenue that SJP earns from them, net income from them, will reduce a little bit, by about 10 basis points. But overall, that moat is not going away anytime soon. Secondly, these changes will have a limited impact on SJP partners' revenue. SJP advisors have an average, this is just average income of 220,000 in 2022, which is broadly in line with the rest of the market, with the rest of the profession. The difference is that much of the regulatory headache, and to some extent some marketing and branding costs, are absorbed by SJP's corporate apparatus. But now the advisor can actually see what that's costing them. It's about 30 basis points. And the question is, for SJP advisors, is that, do you want to stay under the corporate apparatus with all the restriction that comes with it? Or do you want to take your clients, charge them 80 basis points for your advice and have access to an unlimited, a much wider range of products, if you choose, that you can choose of, many of which will be much more lower than what they're paying within the SJP apparatus. I mean, an advisor can charge 1% and still be cheaper and have better product, than they would do with SJP. So, my rough estimate is that average SJP advisors actually look after around 32 million of client assets. And I wager that most of the SJP partners will do much better. They'll do much better. Their client trusts them for their own service. They'll do much better in terms of revenue and bottom line profitability than they do within the SJP corporate machine. SJP advisors are among some of the best IFAs that I know. But with a third of their client asset trapped in gestation, I doubt that many of them will consider jumping the ship. So, and another point, another one of SJP's moats is actually this 8 times revenue multiple offered to advisors to buy their practice. So SJP offers loans to, partners to buy out their retiring counterparts, or their counterparts who just want to leave. And it's a way to guarantee that assets never leaves the firm, and give both parties, the retiring or the exiting advisor and the advisors buying, it gives them an incredibly attractive incentive to stay within the SJP until they retire or die. So I guess we'll see if that multiple changes, but I don't know. I don't think so. But if that, and if that is still on the table, it reduces. Even if it reduces to, say, 6 times rather than 8 times, it's still very compelling compared to what these advisors can do. In the independent world. And if you're an advisor and you bought or acquired SJP book of business, you probably have a loan over a 5 or 7 year period outstanding. You're not going to leave. If you want to leave, you have to pay back the loan. So again, that moat is still pretty strong. So my overall sense is that this news is clearly I would say, is mildly positive for SJP future clients. Maybe for existing clients in the medium term, it's probably neutral for SJP's advisors. But they slightly, very, very slightly weaken SJP's moat, the moat of the SJP corporate machine. I don't see them as actually changing changing much massively for the organization or for its advisors. But I guess we'll see. Changing fee structure is one thing. changing the incentive structure and the deeply embedded product sales culture is quite another. I am just as much uh, of a spectator in this as you are, but I hope that this conversation is being useful. Thank you and goodbye. That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.